Hello, everybody. Welcome to Friday and another Talk Money with Tom show today. Really glad that you could join us. We just got off of our vacation, a couple of Fridays here, what we missed. So this is exciting to get started again. This show is about helping people to kind of create a more successful retirement. And we focus on retirement planning, tax planning, and of course, asset management. So it's a question and answer show. You can send in your questions now if you'd like. We have an email address here, asktom@talkmoneywithtom.com, or you can put it in the chat window that you see here. Eason is with us today also, another one of our advisors. He'll be the one kind of moderating, asking the questions. I'll try to answer it. He can fill in things, ask follow-up questions. We try to, build out the subject as much as possible. Some of these questions come from strategy sessions that I've had, over the week or what have you with other clients that I think are important for people to understand. And so anyway, these are really fun events for us. We believe that education is a big aspect of what can help somebody have a more successful retirement. And that's what this channel is about. We put out a video almost every single day, maybe even two. And so if you want to get notified when those come out, you can hit the subscribe button, hit the little bell, and you'll be notified when something comes up as far as that goes. So obviously, too, if you have some specific questions that you might want to ask, you can actually book an appointment. You can go to our website. We have a book appointment button, and you just, go ahead and set up a 30-minute phone call or video, and we'll see if we can help you as far as that goes. So thank you for joining us. And I want to start with something here first. I always like to start off the first week, the first part of this show, with just a summary of what I saw happening in the market this week. I thought this was a very interesting week for a couple of reasons. Number one, the first couple of days were pretty good. Looked like we were going to really start to go. And then Wednesday, really big downturn. And Thursday and Friday so far really have just been kind of sideways, hanging into that downturn area. And on Wednesday, the minutes for the Federal Reserve came out. And so that meeting was held back in December 15th. And they had a, post meeting, summary of what they talked about. And they talked about how they're maybe going to raise rates a little bit faster, cut back on their bond purchases a little bit faster. And so the market reacted to that back in December. But what came through in the minutes that wasn't talked about was this concept of letting their balance sheet potentially shrink. So when they buy these bonds, it stimulates the economy, and they were buying $120 billion, a month, but they end up on their balance sheet. And so one of the other ways they can slow down the economy, theoretically, is to, shrink that balance sheet by letting bonds expire or even selling some bonds. And so that wasn't expected, and the market reacted to that pretty aggressively. And that's one of the issues that's going to happen here, in my opinion. I believe that this year will still be a positive year altogether. Maybe that 8 to 12% range on the S&P 500. But these types of years when the Federal Reserve is starting their tightening cycle, although they can be positive years, often are kind of volatile years because of what we just saw on Wednesday. There's just this huge, enormous, attention that's being paid to what the Federal Reserve says. And every time they say something that they see as sort of a tightening issue, then boom, the market reacts to that. Because the more they tighten, the object is to slow down the economy. The more they slow down the economy, the more earnings could start to fall, and the potential for a recession becomes a little bit higher if the Federal Reserve isn't careful. And so that's what the market responds to. And that's kind of what's happening here as far as that goes. So my outlook this year, strategy wise, is to buy companies or categories where I feel like they have pricing power. So for example, in our targeted indexes, one of the things we've been buying is Apple, because I think Apple has the ability to increase their price to a certain degree and still maybe produce similar earnings, which is what you really need to keep the stock growing, besides the fact that they're buying back their own stock at, a $90 billion rate and those types of things. But huge cash flow. They don't rely upon debt. And so you look for things like that. And a lot of those sold off this week. And so, we bought some more. Microsoft and Apple and Google all have really unbelievable, name recognition, kind of scenarios where it's going to be more more possible that they can maintain their price. I think semiconductors as a group is another one, just because there's such heavy demand for semiconductors. Even if the economy starts to slow down a little bit because of interest rate increases or because the bond market becomes a competitive threat, there's still going to be a lot of need for semiconductors, and it's difficult for those to ramp up really quickly. So that I think they control their pricing power. So that's one key thing, I think. The other one is that when you have these kind of volatile years like this, it'll look almost like a sideways year. I think in the end, 8% versus the 27% we just had, it's going to feel like a sideways year, that's for sure. We use what's called opportunistic rebalancing. So we have our portfolio, we have our pie chart, and we buy that pie chart. And then whenever we have these big down days, we go in and rebalance again. And that'll allow us to kind of sell whatever was holding up the most and buy some of the stuff that kind of came down. So we just did that on Thursday after the drop on Wednesday. Bought a little bit more Apple, a little bit more semiconductor, a little bit more S&P 500, for example, in some of the accounts. We only do this in the IRAs because of taxes and what have you. So, but those are strategies that I think are important to employ. The last thing that I would really look at for a year like this is one of the things I see is a lot of people are marching down a path as if they know for sure what's going to happen. We're going to have inflation. We're going to have a bad bond market. We're going to have all of these things happen. And I can say for certainty that most projections are actually wrong. And a lot of times people are going down a path that doesn't actually materialize. And right now, I've never seen a year like 2022 is playing out so far. We have an Omicron variant. We'll probably have some other variants. We have supply chain issues. We have labor issues. We have inflation with this pent-up demand. And it's an election year in the midterm. So there are so many cross currents that are going to happen here. So really trying to stay very, very diversified with the very big indexes like the Vanguard Total Stock Market Index, which owns most of the market, the Vanguard, S&P 500, those types of things make up, 75% of our stock market exposure, just because there's so many current, it's hard to tell where things are going to go. And then really don't react to predictions and make your portfolio, say, inflation proof, because it could go exactly the opposite way. Take the smaller pieces of the portfolio, which is what we've done, and try to make them inflation proof. I think Apple hopefully is inflation proof, at least to a certain degree. Semiconductors, real estate tends to it's doing well right now too. So, those types of areas are worth watching and react to that. So instead of building a portfolio around prediction, build a broad-based portfolio and react with a smaller piece of the portfolio to kind of what you see happening. That's been a strategy that I've used, many years in a row here. That's been much more effective than trying to guess where things are going to go. So anyway, that's what's happening. We're at the beginning of the Fed tightening cycle. Usually the market does okay there, so keep that in mind. There usually is some gains, but it can be more volatile, and we'll just have to be aware of that and figure out ways to take advantage of it as far as I'm concerned. So anyway, that's what my summary is for the week. Thank you very much for listening today, and I look forward to talking to you about this again next week. All right, Ethan, what do we have for questions? I know we got some this week and whatnot.
Yeah, so first question is, we've talked about retirement plans before. What exactly goes into a retirement plan, and what is like a client get with the retirement plan?
Yeah. Okay. So a retirement plan is obviously specifically designed to try to figure out what's going to happen in retirement. Now, you could be already retired and still be looking at a retirement plan, or you could be, looking forward to retirement. So really, it applies to any age. So that's important to consider. You can be 20 or 80, and it still works. And what you're trying to do there in this retirement plan, I look at it kind of simply in the sense that you've got these potential or actual outside income sources coming in. It could be rents, it could be Social Security, it could be pensions, those types of things. So that's coming in. Visually, I look at that like coming into the top. And then we have this asset base, right? What do we have invested in 401ks and IRAs and trust accounts and different types of investments, et cetera. And then we have kind of what we're pulling out the bottom, which is what we're living off of, right? Our basic living expenses, our medical expenses, our got to purchase a car, dental expenses, whatever it might be that's in there, and travel and different things that you want to do. And so the object of doing a retirement plan is to see if what you have, either as a goal, if you're not retired yet, or as an actual situation, if you are retired now, is it in balance? Is that inflow, asset, and outflow in balance? And the way we tell that is through Monte Carlo simulation. So we run, the plan, push the button, we get this Monte Carlo simulation that tells us, what's the probability of success? So how many times out of 1,000 runs through your life did you run out of money? So in our opinion, 85% or higher if you're in retirement is definitely where you kind of want to be to make sure you don't run out of money. And then, of course, that aspect of it is the beginning of a retirement plan. There's tax planning that goes into there, taking a look at how we can minimize taxation, what would happen with the required minimum distributions, what might you do with a Roth conversions fit in that portion, how do you maximize Social Security as part of a retirement plan. Even if you're not taking it yet, it's very useful to know when you might be taking it as soon as possible so that you can kind of orient your portfolio around a strategy to try to make that work. So anyway, those are the issues that I think are probably most prevalent in a retirement plan, and what you get out of that.
Yeah, and going off of that, like, how often do you need to update this kind of plan? Like, can I just make one and like not worry about it for 5, 10 years?
Yeah, yeah. I'd say most of the plans that I've ever seen done are basically door stops, right? I mean, somebody had a plan done at one point. I'd say within 6 to 24 months, it's not really that useful anymore. Nobody looks at it. What we do and what's possible now is really what's called a live retirement plan. So we link in all the assets either that they have with us or even from outside, and it keeps all of the assets live. And then every 6 months, you want to go in and take a look in our strategy session at what's changed in your outflows, anything's changed on your inflows, and that kind of stuff. And then basically run the Monte Carlo simulation. And then we also do stress testing. What happens in a high inflationary environment to your portfolio, what happens in a big downturn, what happens in a long-term care situation. And so what we're trying to do is figure out how robust is your retirement plan. Again, whether you're retired or not, those are things that you need to kind of focus on. So yeah, every 6 months would be my outlook. The other part of this that's very interesting to me is that my wealthy clients have one criteria, or one similar characteristic, in that they worry about having enough money, and that's how they accumulated the money. They, for their whole life, they've worried about making sure they have enough money, and so they save and save and save, and that doesn't change no matter how much money they end up with. They still have that concern. So one of the things that I think is really great about doing the plan, every 6 months, looking at the Monte Carlo simulation, doing the stress testing, is it just there's a little bit of relief. Okay, good. At least for now, it looks pretty good. But even more importantly, it's a future look, right? So if all of a sudden somebody's plan shifts back to 75% or 70% or something probability of success, we have some time to maybe make some adjustments. 5, 10 years maybe even, to make some adjustments to their portfolios, their inflows, their outflows, whatever we have to do to kind of make it work so they can get back to that kind of 85% or higher. And they love that, right? Because it's part of that worry cycle, is to make sure that they have enough money. And this is a good way of figuring that out. So yeah, I think that's a really, really important component. It's the big difference. A lot of times somebody does a plan to get the situation started, right? So an advisor would come, you come in, you see, do the plan and to get all this thing going, and boom, you never see the plan again. And all you're doing is talking about the assets and different things. Honestly, without the plan, I don't think we can do the good work. We can't do the tax planning properly, and we can't really tell in advance if you're going to run out of money without the plan being live and ready to go. So that's a big deal.
Yeah, you talked about this 85% probability of success. You know, is that like a benchmark that we should hit like throughout our life or like different stages of life, or is it only, we only need to be there at retirement and in retirement?
Yeah, when you, it kind of depends. I would say in retirement is more important, um, uh, but it still needs to be there. If I retire at 40 or if I retire at 70, it should still be at that retirement point at 85 or above as much as possible, right? So I still think once you're in retirement, it's way harder to keep it at 85 if you retire at 40, just because of the number of years that you might be living off the money, right? But prior to retirement, we often see, especially for younger people, somebody who's 40 who wants to retire at 65. We'll often see plans that don't quite work out, so it's at 60% or 70% or something like that. And those tend to kind of mature over time. They save the money, they get it going. Hopefully, we can get a good rate of return. And again, we'd like to see it get to 85 by retirement, but I think you could be under that prior to retirement, especially if you're far enough away to be able to continually push that forward. And that's the big advantage, again, even for that group, of looking at it every 6 months. This is where I am, this is where I'm trying to get to, and you can see improvement or not, and all these things that happen. So it makes some guidance. Or I guess another way to look at it is we could make adjustments. Maybe we work a few more years, maybe we spend a little bit less money, maybe we save a little bit more money, that type of thing. Maybe we cash out the house and move to a different state with a lower cost, and pull money out of home that way, or whatever it might be. There's lots of options.
Yeah, that's pretty important for a lot of people to know where they're at
Mm-hmm.
any point in life. So, why does inflation make stocks go down, and does it affect different kind of types of stock differently?
Yeah. So the big theory behind inflation making stocks go down, first of all, understand that it doesn't always make stocks go down. It's really high inflation or quick inflation that makes stocks go down. So it's the acceleration of inflation that has the biggest impact. I saw a big study. It's really fascinating. So, and that's kind of what we've had here, right? We've had this inflation that's gone up very quickly. It's a little bit, of a weird scenario because we have this pandemic, right? This isn't a normal inflationary cycle. It could be partially temporary. They could figure out some of the supply chain constraints, so we'll see how that plays out. But a high, fast growing inflation creates problems for stocks. But overall, the concept of inflation is an issue for stocks because of what the Federal Reserve does to fight it. So the Federal Reserve sees inflations. They have two mandates, kind of trying to create full employment and then trying to keep inflation low. And the idea behind keeping inflation low, it allows companies a better chance to kind of plan, with their expansions and different things like that. When inflation is, 1.5 to 2.5%, companies are a lot more comfortable in their planning environment. When inflation is at 7 and 10 and moving all over the place, it gets to be really difficult to figure out your projects. And so the Federal Reserve comes in and they start tightening up. And they tighten up in three different ways right now. One, they're cutting back on their stimulus, bond buying, right? They call it quantitative easing. They're cutting that back. And they can sell off some of the bonds that they've purchased, and then the biggest one really is interest rate increases. So as they increase interest rates, the cost goes up for everybody. So if you're using a credit card and you're paying the interest, that gets more expensive. If you're going to go buy a car that you used to get for 1.9% loan and now it's 5.9% loan, less people buy cars. If your mortgages were 2.5 to 3.5% on a house, and now it's 6 or 7, a lot less people buy homes. And homes is a huge economic boom because there's so many people involved with building homes and selling homes and what have you. So when that drops down, that takes a piece of the economy. And then companies themselves that do borrow to grow, obviously the cost of borrowing goes up. So the combination of all of these things slows down the economy, which is what they're trying to do. A slower economy would have theoretically less inflation. There's a lot of variables in here, but these are generic terms. And So when you get this scenario where all of a sudden, the economy is slowing down quite a bit, obviously earnings start to fall, and that's the key driver for the stock market. Now, keep in mind that they haven't even raised rates yet. The market's already kind of reacting and getting a little volatile because the market is a forward-looking mechanism. It's looking, 6 to 24 months down the road and seeing a higher inflationary potential environment or higher interest rate environment that could slow the economy down some. And unfortunately, this is combined in this environment right now with some worry that the Federal Reserve could be fighting inflation that doesn't happen because, say, Omicron comes along, something like that, that slows things down by itself, or the supply chain that is causing so much as inflation now unwinds itself and gets much more efficient again, and all of a sudden inflation comes down. So if you're slowing down an economy that's already going to slow down, you might have some problems there. So that's always an issue too. There's not always the Federal Reserve has been wrong a lot, and so there's some concerns there that they're on going too slow, going too fast. It depends on who you talk to. So that's the big issue with inflation as far as that goes. But and we've always had inflation. We had a 12-year run from 2010 to till the pandemic here, and we really had some inflation all the way through there. So lower levels of inflation isn't a big issue. It's just higher levels and especially spiking levels that create the most problem, and maybe just more uncertainty in general as far as that goes. Last piece is that there becomes a competitive asset. So if I can get a treasury bond, I'm making this up, but at 8%, right now the 10-year treasury is at 1.7 something percent, so it's a long ways from that. But if I can get a 10-year treasury that'll pay me 8% a year, and the stock market's averaging 11, I have virtually no risk in that treasury and lots of risk in that stock market. So there becomes competitive asset class. So it's a CDs or bonds or treasuries or those types of things start to pay such high rates. Less people will buy stocks in that environment, just because there's other safer places to go to get nearly the same rates of return. We've had just the opposite. One of the reasons I was so positive about this last year being a great year, because there was still nowhere else to go. It was going to be real estate and stocks, right? Because the banks weren't paying anything. That's starting to change this year, in my opinion, at least a little bit. So yeah, that's and then ultimately the Federal Reserve raises rates like we saw prior to 2008. If they overdo it like they did in 2008, we end up with a big, enough slowdown and enough risk being taken, you can have an implosion in the financial system like we did in 2008. So the late cycle tightening is the scariest part to the market. And so that's what's kind of creating some of this, issues right now.
Yeah. So how does that play into a value stock versus a growth stock? Is it should I overweight one of the other over the other based on if I for inflation?
Yeah. Well, first of all, I think it's important to realize that we might not have inflation. So I think a lot of people are marching down the road as if it's a done deal. We've have had inflation. There's a likelihood that we would have inflation, but I'd be very careful about overweighting your portfolio based on what you think might happen with inflation here, and or even you're changing your bond strategy dramatically. I'd still stay very diversified, and we're talking about the little pieces that you might move dealing with inflation. So, for example, in our bond portfolio, our targeted pieces are in these treasury tips, right? Treasury insured protection securities, treasury inflation protection securities. And so the key there is, be a little bit careful, but yeah, altogether value theoretically does better in an inflationary environment than growth. And the real reason is because value has lower multiple PE ratio. So the price compared to the earnings. So if your price compared to earnings is 9 or 10 versus another company who's at 300, like some of these really high flyer growth stocks, that's why you'll see a lot of those high flyer growth stocks really come down. And it has a lot to do with what they call the discount mechanism. So it gets a little sophisticated, but if the payback period is 300 years and you're discounting back at a higher interest rate, the current value is lower, and there you would adjust theoretically the price, versus a payback period is 10 years. Even at that same interest rate, discounting back to current, there's less impact on the price. And so you'll often see value stocks do better in an inflationary situation. Although last year we saw it kind of like temporary move into the value area. and growth still, especially the big growth stocks, still did well because it's really, I'm telling you, these companies make hundreds of billions of dollars of cash flow. And so it's hard to beat. That's why I like the Apples and what have you too, even in inflation environment, because the earnings are still so fantastic, especially in a demand environment where we have a lot of excess cash on the sides that are coming in. So yeah, but it's a good question. It's a good thought.
Yeah. Our next question is about cryptocurrency. You know, the question is, I want to add some cryptocurrency to my portfolio. Should I be looking to pick individual coins that I think will be winners, or should I try and buy a basket of coins? And if I get a basket, how many coins should I get? And then how should I, weigh each coin? Should I be having them equal, or should I do it differently?
Yeah, so this is kind of interesting because I'm not an expert at cryptocurrency per se, but I relate it to the way that these indexes are set up. If I was going to go out and do cryptocurrency, I would do it very similar to these market weighted indexes. So if you went to Coinbase, it gives you access to, quite a few different currencies. I mean, sorry, cryptocurrencies. And you can calculate kind of what the market cap is. How many of those coins are available essentially versus the value of that coin right now and figure out the market cap. So I might take 5, 10, 15, or 20 of those top ones in terms of market cap. And the number would depend on how much, I have to invest, right? So if I didn't have much, I'd probably stick with 5. And if I was investing a lot, I'd probably go closer to 20. And I'd take those top 5 to 20 cryptocurrencies by market weight, and I'd create my own little index. And I'd buy on the same percentages. So if one of them, the biggest one was, 7% of the 20 I was going to buy, I'd buy 7 of that and 6 of the next ones and 4 of the next one, etc. And that's how market cap weighted indexes work. And the thought process, actually, this is one of the Vanguard's advocations, is that the market is already voting on what they see as the best. And so whatever is the highest market capitalization it's getting the most votes from the market, right? And it doesn't mean that there won't be another one that comes up and supplants it at some point in time. But that's why you would maybe adjust that index based on, what you adjust your holdings based on what's happening with that market capitalization, maybe once a year, once a quarter, or something like that, depending on how active you want to be. So I think beyond that, once I've created my little index, I might go, if I had something beyond that wasn't in the top 20, I call that the targeted index. I might go out and buy 1 or 2 or 3 of those little altcoins that I think just have great potential. I'd keep my bets smaller in that area. I'd probably do it very much like I do my current portfolio with 75% in that index-based thing that I just created. And then the other, 25% might be in these little altcoins or something like that I happen to think, because there's bound to be something outside of that top 20 list that you're excited about for some reason. And so I probably would keep some, fairly tight reins on things, but that's difficult to do because they do move so much. Probably just means keeping the dollar amount smaller. Because actually, for most things, if they really, really work, you don't need a lot of money. I have a client that bought $14,000 worth of Apple back in '96 when it looked like it was falling apart. It's worth over 3 million now. So it doesn't take a lot of money sometimes to make a lot of money if it's going to work.
Yeah, and we've touched upon this concept too with like when we talk about megatrends, how we can't really pick the initial stock winners out there. Like when Amazon came out of like the .com boom, we can't pick the next Amazon, but if we buy everything or a big portion of it, we still have that like chance that we'll still go up with that boom, but maybe not as much as picking a winner.
Yeah, I remember seeing a story where they said, okay, the .com retail stocks, the number one stock back in, I don't know, mid '90s, what have you, was called eToys, and so if you bought eToys, it actually went out of business. And so if you just if you bought Amazon, you would have done spectacular. But if you just bought all of them, and so that's what creating this index would be, you still did really, really well altogether. And so I think, especially in these really volatile type things, I would be looking at that kind of diversified. I don't know that there's any indexes available of cryptocurrencies, so I'd be making my own as far as that goes. But that it's exactly right because I don't know for sure which one's going to go up or which one's going to do poorly for that matter. And so having that kind of diversified approach to it instead of chasing my tail. Now, if you do get the right one, right, that's the best thing. You can really win if you happen to pick the right one. But that's just, if I happen to win the lottery, I can be quite wealthy also. So I like to diversify that risk out and maybe play on the margins trying to guess which one's going to be the right one. I like both. I like that kind of buy and hold index combined with that kind of targeted, slightly skewed, concept of trying to figure out where things might be going. I feel that, kind of bridges both types of investing.
Yeah. So earlier in the show, you talked about rebalancing. So how often should I rebalance? Should this be portfolio based? It should be like once every 6 months kind of thing. And does the type of account affect the like when I rebalance?
Yeah. Uh, Overall, one of the concepts of rebalancing is just to maintain your risk level. So if I have a 60% stock portfolio and 40% bond, I've done some work to figure out that that fits my risk tolerance. And the stock market continues to outperform the bond market. All of a sudden, I have a 75% stock and 25% bond. I actually don't have the same risk portfolio anymore. And so, even just, kind of paring it back again, even if it's annual or those types of things to keep your risk level at the same, it depends. If your risk level is changing, maybe you don't. But that's a big piece of it, at least for advisors. That's one of the things because we sign up clients for certain risk levels, and letting the accounts go way out of that, is a good way to get sued. So that's one strategy. I would be very careful with how you do it on a taxable account. And we have to work through those kind of on a custom basis, one at a time, just to try to make sure we're not kicking off tons of taxes as far as that goes. So that you want to just kind of work through. You have some pieces that you love that aren't doing as well anymore. Maybe you take some profits on that and reallocate that back down. And so that tends to be more of a custom issue. But inside of a retirement plan, we do have some unique things we can do because nowadays we don't have transaction costs. So even if we're only buying, a few shares here and there, it doesn't matter. And we also don't have taxes to deal with. So my advocation is what's called opportunistic rebalancing. There's a lot of different strategies for how you would do that. I know BlackRock came out with a whole thing that basically said once you're 5% off, you should rebalance. So if you're at 60% stock and it goes to 65, you should rebalance. If it goes to 55, you should rebalance. They did a big study and fairly convincing looking results that that was the best time to rebalance. I tend to be a little bit more reactive, so we rebalanced on Thursday after the, market dropped and some of the pieces we had that I wanted to, kind of take advantage of. So that's how I do it. I wait for downturns and I rebalance. And if it goes down farther, I'll rebalance some more. And again, it's very easy for us. We can rebalance hundreds of accounts with the push of a button, essentially pretty quickly. Um, but that there are different strategies on how often and what have you. I would definitely try to make sure I at least do it enough to keep my risk at the level that I am comfortable with. The rest is just trying to maximize returns in different environments. So I think rebalancing is going to be more important on an opportunistic side here in 2022. That's my prediction because I think this is going to be what looks like more of a sideways type year. And so if you get a little dip and you rebalance and it comes back, you actually made money, even though, theoretically it didn't go anywhere. So I think it's one of the ways to make money in markets like this.
Yeah. For rebalancing, do you ever think about in the individual holdings rebalancing, or do you look at it kind of as an asset class? So when it gets to 65, 5% over the regular asset classes, or each holding kind of skews out too far?
I've done both. I think what BlackRock has done is pretty valid. So I've used that last year. I did more of that because especially in trending markets, you can go from 60% to 65% pretty quickly because the market's really, I mean, the S&P 500 was up 27% last year. And so, but inside of those asset classes, I have all these pieces, and I still want to do the pieces because that's important to me. Generally, things do cycle, right? So, if something is down a little bit and something else is up, when I do rebalancing, it forces me to sell a little bit high and buy a little bit low, right? As long as I'm comfortable with everything that's in that portfolio, I should want to do that as far as that goes. So, uh, uh, but right now, this year, I'm going to be looking much more so at kind of downturns to use to rebalance again in the IRA type, Roth IRA type assets where I don't have to worry about taxes. Um, Outside of that, and the taxable accounts, where just we've been slowly but surely getting them back to an overall asset balance between stock and bond for the most part, and trying to minimize taxes.
Yeah. So this is our first show of the year. Is there any kind of New Year's resolutions that I can do for my finances?
Huh. Yeah. Well, one thing, I mean, there's a lot of different things in a lot of different categories, but one thing that I am doing is I have pieces that we bought in 2020 that did phenomenally well, and they've come down some. I haven't wanted to sell them at the end of, they especially came down at the end of the year. I didn't want to sell them at the end of the year because the tax return was just around the corner. So I have been lightening up on those types of things. So if you have things in your portfolio that are at gains, that you're not so sure are going to continue to keep those gains, this is a good time to sell them because now you have the gains and you can work them off for the rest of the year. If you buy something that doesn't work out very well, or if one of your positions turns into a loss, you can sell it, capture that loss, offset whatever gains that you took this week. So that to me is one thing that we do, on a consistent basis. Um, I think there's a whole host of different areas that we could look at in terms of what you might want to do. I would say making sure that your budgets and your goals and those types of things are in line. It's kind of a New Year's resolution type concept as far as that goes. Is important also. But yeah, it's for me right now. I've been really focused on kind of the capital gain issue.
Yeah, for this year, I looked at my budget and I realized that I was spending a little bit too much on takeout. So, you know, uh, just maybe one or two more meals that I cook myself is the goal this year.
Yeah,
Each week to
yeah,
save that money, and trying to find where maybe I'm losing a little bit of extra more money than I want to be losing. And then another thing was I looked at my contribution percentages and I decided that I want to maybe bump it up a couple percentages this year. And
yeah.
so maybe that's something you reevaluate is like, hey, like I got a raise maybe late last year. Do I want to be saving a little bit more of that money this year? And so you could do that.
Yeah, that's good points. I mean, so what you save on, some area, I especially like saving money on things that don't dramatically impact my lifestyle, right? And there's always these little things that accumulate that I haven't stopped, subscriptions and different things that I'm not using anymore, and then apply that towards your, contribution to your retirement plans or what have you. Yeah, that's a great New Year's resolution right there. Is just to try to get, more fiscally sound this year and continue to do that. I would say across the country, if you look at the numbers, people are really doing a great job financially in comparison. Not everybody, right? There's always this bifurcation, but if you look at the averages, they've gotten a lot better. Savings rates are a lot higher. People are in much better position. Debts are lower, which is kind of nice. So yeah, it's still a good time to refinance if you're got a higher mortgage, and I do that really quick because boy, mortgage rates are shooting up. That might be a New Year's resolution right there. If you have a mortgage that's at 4, 5, 6% for some reason, now's the time to do it because mortgage rates are really starting to move upward right now. So that could be a big savings, right? Most people have already done it, but if you haven't, then now's the time.
Yeah, this is a question as just as a general investor. When do you take profits on investment?
Hmm.
You know, like whenever, if it's a taxable account, if you have a high flyer and you rack up those gains, selling it is you gotta pay a lot of tax. You gotta pay that tax on that.
Yeah, it's two different strategies for when you would take profits based on what type of accounts it's in. It's in taxable account or it's in a tax deferred, tax free account, right? So tax deferred, tax free, I use much more so my signals. I have momentum breakout bands that I use and moving average crossovers and all these different things. And I try to look at relative strength and I want to keep things that are rolling and get rid of things that stopped rolling. And, at least for the targeted indexes pieces that I'm not kind of buy and hold on because I don't have to worry about tax. So it's a different story. Now, if you look at the taxable accounts, yeah, it's a big difference. So, we bought a lot of clean energy, innovative technology, and genomics in 2020, some of which we bought in the taxable accounts. They all went bananas to the upside and have since maybe last February, mid February, have been kind of eroding, right? And in hindsight, we should have just taken the profits because some of those did erode. But hindsight's, what is it? Coulda, woulda, shoulda is undefeated, right? I mean, that's that portion. So because you got all kinds of problems. If we would have sold in February or March at the much higher point, it's a short term capital gain, so the taxes on that can be quite a bit higher than long term capital gains. You got to hold on to it for a year, but just trying to hold on to something for a year that's falling and falling and falling till your taxes. So, yeah, it's actually pretty difficult. I kind of have a rule where I don't want my profit to fall by more than half in a taxable account. I want to hold on to it. I hope it keeps going. And maybe it's just dipping for a while and then it's going to take off again. I've had that happen a lot of different times. That hasn't been true this time period that we're dealing with the stuff from 2020, but it still could be. I mean, clean energy is the future, right? So eventually that's going to take off. So I'd like to hang in there, but I don't want that. I don't want that profit to go to zero. So I've had $100,000 profit. If it gets to 50, I want to sell it, even if it's a short-term gain, especially if what I'm looking at is a momentum that is very downward based, and I look at the chart and just I feel bad about what I see. I don't want to hang in there on that any longer. So, but it's not easy. That's a totally subjective concept and very, very difficult to actually nail down how you do that. It's not easy.
Yeah, and it's really rough because like when you take these gains, especially when you're retired, it changes your Medicare. You have more expenses in theory, but you have to think about it as a net gain.
Yeah.
Say I have $50,000 of a short term gain and I sold it.
Yep.
I but I only pay a portion of that in taxes,
Right.
the increased Medicare, and I still come out with a little bit more money
Yeah.
for what I did. So it's important to think about the net rather than just the individual events by themselves.
Yeah. This is a really hard thing that we deal with the client. So let's say somebody had $100,000 gain, and maybe I sold it at 80,000 in their IRA, but I still have it in their taxable account, and it drops down, it gets to 50, and I want to sell it because that's my rule. Get to half, I sell it, and then boy, they're wow, that's just so much money on my tax return, and they're calling me up and asking me, and but by the time they're calling me, it's at $10,000 gain. So we save $40,000 of loss, let's say for example, and so that's a good point. My point is, look, even after tax, even take some more money out to pay the extra Medicare for the year or two, you're still way ahead. But the problem is that it could go the other way. You take the $50,000 gain, and then the thing turns around, and you would have been better off holding on to it. So there isn't, without a crystal ball, there's no perfect way to know, and that's why I kind of use this half rule. But you're exactly right. It's still better to have a profit than none, and it's pretty easy, and especially in this pandemic. There's been a really weird time frame. It's pretty easy to end up with a loss if you're not careful. So I still like taking profits. They don't take it all. They don't take it all. They take a chunk of it, but they don't take it all. So yeah, I agree with that wholeheartedly. So okay, good. Well, that was our show for today. I want to thank everybody who had a chance to join us and really appreciate that. Again, if you're interested, please subscribe to the channel. Hit the little button there for the bell if you want to get notified when these videos come onto our channel. And again, if you'd like to set up an appointment to try to see if there's something we might be able to do with you, you can go to the website and you can take a look at what we have there for the book appointment button and try to pick out a time that works for you. So I want to thank everybody very much for coming, and I look forward to seeing you next week. Thank you.